Asian markets plunged Friday. Stocks were sold off as President Donald Trump sparked fresh trade war fears. He saw his America First promise through, announcing that his trade secretary would announce in 15 days which $50 billion worth of Chinese products would be liable to import tariffs. The most impacted regional countries include Korea and Taiwan, as companies domiciled in these markets make up a significant portion of the global production chain of Chinese exports. Japanese stocks experienced serious turbulence, with the Nikkei share average tumbling by 4.5%. Hong Kong stocks collapsed during the session by as much as 4%. By the close of trade, the Hang Seng Index was down 2.5%. China responded to the import tariffs announcement by saying it was not afraid of a trade war and released a list of potential tariffs on $3 billion worth of US goods, ranging from pork to fruits and wine, and also including steel and aluminium goods. The Shanghai Composite Index declined by 3.4%. And over the United States, Wall Street stocks suffered their biggest drop in 6 weeks. This on the back of Mr. Trump's trade protection measures against China. Market players are concerned about a potential tit-for-tat situation, with many analysts warning that a trade war will hamper the so-called synchronized global growth story, resulting in a zero-sum game. The Dow Jones Industrial Average fell by 2.9%, the S&P 500 lost 2.5%, and the tech-heavy Nasdaq Composite Index dropped 2.4%. Well, market mayhem is the order of the day, with trade protectionism at the forefront of investor woes. The local all-share index is deeply in the red, being dragged down by industrial and mining counters. Naspers lost out on the market rout, having sold 2% of its stake in Hong Kong's Tencent. It expected to accrue 125 billion rand, but got shortchanged on the dip, accruing only 116 billion instead. Still, of course, that's no chomp change. Risk aversion has given the gold price a lift, while oil prices have also firmed, as Saudi Arabia indicated that OPEC and Russia oil production cuts could be maintained well into next year. Meanwhile, the local currency is trading a tad weaker against the US dollar, this ahead of the Moody's credit rating decision on South Africa, which most pundits believe South Africa will be afforded a stay of execution this time around. Let's take a look at the indicators. Well, I'm joined by Warwick Lucas, Chief Investment Officer at Galileo Capital. Thanks for joining us, sir.
My pleasure.
Has Mr. Trump fired the first shot in the trade war? And what are the consequences for the global economy and markets?
Okay, pretty much. If we look perhaps at the economics behind it and the history, we'll find that emerging economies have often made use of intellectual property of much more developed countries, and those developed countries have typically turned a blind eye to it. But we now have the situation that China has continued to make use of intellectual property. It's now the world's second biggest economy, probably one of its strongest militaries, and the poverty card's no longer going to work. And I think that as a result, we've come to a battle that certainly in the US point of view is long overdue. In terms of winners and losers, well, I think that the US can hurt China much more than vice versa. But the problem with trade wars is that it's not so much winners as who comes first and who comes second, but there's still a net loss, really. So we have the situation that the US can look broadly across, and in particular area that could be hurt and flowing back into the US would be the likes of the tech companies. China, for its part, can try and retaliate with tariffs on the likes of soy production, agricultural products, generally trying to attack the areas in which Trump's voting base is strongest.
I mentioned a zero-sum game. You reckon that the US could probably hurt China more than the other way around, but China holds a lot of its reserves holds a lot of US debt in its reserves, and I'm sure it could really rattle the cage for the United States, which has a massive trade deficit.
Well, it would be problematic, but on the other hand, it would create a currency distortion that would work against them. So I don't think that that's an error that China would basically try to use, no.
So for commodity exporting countries like South Africa, what does this whole thing mean? Because obviously the commodities have been severely affected as a result. Can we expect more red, in terms of the equities markets and other markets like commodities, given the fact that this is going to be an ongoing story?
The key issue is how does global trade get affected? Now, at this stage, what we've seen from Trump is that it's clearly going to be the US going it alone, even though the EU would justifiably have a case against China as well. I think Trump took the view that, particularly given that Germany runs a massive trade surplus with China based on capital goods, that the EU would not be much good as a partner to go in with it. And I think that's partially why he's gone such a non-consensus, such a hostile route on their own. So from that point of view, negative for commodity trade generally, but what does it do to global trade? If we see a rolling tit for tat that grows and grows and grows, potentially very negative indeed. Otherwise, I suppose we could go with a more moderately negative point of view.
And then today here in South Africa, we are eagerly awaiting the pronouncement of Moody's. We've been talking about it to death in the run-up to it. But I'd just like you to remind our viewers of what's at stake should they decide to downgrade us to junk.
All right, so nuts and bolts. I mean, first of all, it's once you lose your investment grade rating, it's quite hard to get it back. Takes quite a few years of apparent reform and all the rest of it, even though I think those blocks are already starting to come into place anyway. In terms of numbers, we'd probably look at a withdrawal from South African government and parastatal bonds, around about 100 billion rand. Probably a pressure on interest rates upwards of between 75 to 100 basis points, and possibly a knock to the rand of about a rand versus the dollar. So moving basically from around about 12 to around about 13 to the dollar. So it's not an attractive scenario, and certainly I hope Moody's doesn't go there, because frankly it's not necessary at this stage.
Well, let's talk about hopefully the reverse of what you're talking about. You say that if that were to happen, we could see interest rates hiking. But of course, many economists hoping that the Reserve Bank will cut rates next week. Do you think that's a real prospect, especially in light of the fact that the Fed actually increased rates this week?
Well, I certainly would hope so. I mean, first of all, the South African consumer, although finding some of their confidence still very much flat on their backs, inflation is sitting well below midpoint. The Ramaphosa rally has frankly been quite a large one. We've seen a big recovery in the rand, and that's ignoring commodity prices, etc. So there's a fair bit of slack in place for a 25 bip cut.
And then very quickly, there's this one particular stock, Resilient Property Group. They've been in the news for all, for bad reasons, basically, and they've lost about 60% of their value in this year alone. What are the issues with this particular company for people who are trading at home and want to know whether it's a good bet or not? Okay, so first of all, before comparisons get made, I don't think it's a sign-off scenario. Let's take that one right off the table. I think the scenario was that for a long time, Resilient was seen to be a go-go company. It did have some good ideas, it had some great growth plans. You got a big premium in the share price. The management is accused of pushing that share price. Whether they did or not, I'm not sure about it, but certainly they did use their scrip when it was expensive, which helped them acquire, and so it fueled an earnings upward spiral, which has now come to a very sharp and hard stop. I think at this point it probably represents value, I should say. Whether it actually is a great buy and whether there's a big investigation and upset and tears and what have you post recent events, well, that remains to be seen, but I think we're looking at a period of consolidation there. It's probably an interesting play for people who are looking for a bit of income out there. All right, okay, we'll leave it there. Thank you very much for your time as always. Warwick Lucas, Chief Investment Officer at Galileo Capital. After a short break, Francis has more business news.